Smart gifting in 2026 is about one thing: moving money to the people you care about with minimal friction, minimal paperwork, and fewer future tax headaches. The first rule to know is the annual gift exclusion. In 2026, you can generally give $19,000 per recipient without using any of your lifetime exemption. The key phrase is per recipient, because that's how families scale tax-free transfers. If you have multiple recipients, the math multiplies. Gifts to one child, two children, and several grandchildren can all qualify separately, as long as each person stays within the annual exclusion amount for that year. Married couples have an extra lever called gift splitting. In many cases, a couple can effectively transfer the annual amount as a team, often described as $38,000 per recipient, but gift splitting has reporting rules and it is handled through a gift tax return when needed. Here is the biggest misconception: giving more than the annual exclusion doesn't automatically mean you pay gift tax. Often, it means you may need to report the gift, and the amount above the annual exclusion can reduce your lifetime exemption over time. In 2026, the basic exclusion amount for estate and gift tax is $15 million per person. That is the lifetime bucket that can cover larger transfers beyond annual exclusions for many families, especially those doing advanced planning. So think of gifting as a two-layer system. Layer 1 is repeatable annual gifts that can happen every year. Layer 2 is larger transfers that may be reportable, tracked, and applied against the lifetime exemption. Now let's get practical with the smartest tax-free moves families overlook. One of the most powerful is paying tuition directly to the school. Another is paying medical expenses directly to the provider. The direct part matters, because giving cash to a person first is not the same thing under the rules. A real family scenario is helping with college. Instead of gifting money to a grandchild and hoping it's handled cleanly, families often prefer direct tuition payments so the transfer is clearly categorized and easier to document. Another scenario is healthcare support for parents or adult children. Direct payments to a medical provider can be cleaner than cash gifts when the goal is covering a specific medical cost. Down payments are another common use case. A gift for a home purchase can be straightforward, but it can create delays if it isn't documented properly for the mortgage process, because lenders often need a clear gift letter and traceable funds. A simple cash gift is fast and gives the recipient full control. A more structured approach, like a trust, is often about control and protection, not just taxes. When families use trusts, they're usually trying to solve practical issues: timing of distributions, protection from creditors, or guarding against a big financial decision made at the wrong moment. That structure can matter more than the tax detail in real life. Now a critical edge case: gifts to a spouse who is not a US citizen follow a different annual limit. The IRS notes that the threshold is $194,000 in 2026, which is separate from the standard annual exclusion. If you cross a reporting threshold, you often hear Form 709. Form 709 is the gift tax return used to report certain gifts, and reporting is typically calendar year based, which is why tracking gifts during the year matters. A simple system makes this easy. List your recipients, decide the purpose of each transfer, choose whether it's annual gifting, direct tuition, or medical payment, or a larger transfer, and then track what was actually sent during the year. The goal of smart gifting in 2026 is clarity. Clarity on amounts, clarity on recipients, clarity on whether the transfer was direct to an institution, and clarity in your records. When you run gifting like a system instead of a one-off decision, you reduce friction now and you reduce surprises later, especially when your family's financial picture gets more complex.